to the Treasury Select Committee on Tuesday the 29th of April 2025. We're here today to look at the work of the Prudential Regulation Authority, obviously a crucial part of the financial regulatory system. And I'm really delighted to welcome Sam Woods, who's the Deputy Governor for Prudential Regulation at the Bank of England and Chief Executive of the Prudential Regulation Authority. He's joined by David Bailey, who's an Executive Director for Prudential Policy at the Bank of England, and Tanya Castell, who's an external member of the Prudential Regulation Committee. So a warm welcome to you all, and thank you for coming today. I'm going to ask Mr. John Glenn MP to kick off.
Thank you, Chair. Mr. Woods, could I turn to recent events in terms of the tariffs and the volatility that we've seen with events from the US? What you as an organisation, your organisation does is quite technical, some of it's quite complex, and for most people they wouldn't really understand the sort of calibrations that you're having to deal with. But could you explain to the committee how you feel firms that you regulate have weathered the fallout from the tariff announcements on the 2nd of April, please?
Yes, thank you, Ms. Glenn, and good to see you, and thanks for having us up here today. So the first impact was a very significant movement in the share prices, particularly of our banks. So we had share price movements of up to 20% for some of our banks. Those have since come back in. As of today, they're all trading a few points either side of 0% since before the announcement. It's unusual for us to have that much value wiped off the value of our banks. In the course of a day or two, I spoke to all the CEOs of the mainly affected banks while that was happening. But what we really watch for is for the risk of contagion into funding. That's what we really care about. And we didn't really see any of that. We did see a movement out in the senior CDS spread, which is a metric that we use to assess how expensive it is for banks to fund themselves. The 5-year CDS moved out by 10 to 15 basis points on the day after Liberation Day. That, though, was in line with wider corporate moves, so nothing there to concern us. There was nothing on customer behaviour that we saw again, which is a thing that we track very closely. The insurers moved off a bit, but not as much, more like the domestic UK banks did. And the main thing, perhaps to mention just to close my answer, is on the Wednesday following Liberation Day, we did have this very unusual move in financial markets, which was the dollar selling off and treasuries selling off, that is US government bonds. And normally we see the opposite in these, what we call a risk-off type of conditions. Normally we see a flight into those types of assets. So that was quite concerning. It's notable to me that it was the next day that President Trump decided to announce his 90-day pause, which settled that all down. Yeah.
And what about the problems in the non-bank sector and private markets, and what impact have they had on the PRA-regulated firms?
Well, it's been interesting, Mr. Glenn, and in a way a pleasant surprise in that I thought it very likely that with the kind of level of volatility we've seen, including intraday, that there would be some problems with margin calls. That's usually kind of first dog to bark. We actually have seen nothing significant. There have been one or two minor things, but that's actually worked pretty well. And I've been asking myself, why is that the case? And I've also been asking other people that question. And I think it is probably mainly because what we call the dash for cash after COVID, or as COVID arrived, was a very extreme phenomenon. I think that's sufficiently close in the rearview mirror that many of the funds have that in their mind and were better prepared. It is also the case, I believe, that quite a lot of the larger hedge funds did de-risk quite significantly going into Liberation Day. So I think those two things together have made it work better.
Okay. But so since the 2nd of April, what is the PRA doing differently than it did before? Are there any meaningful, enduring lessons you've taken from what you've seen in the markets and the activity of the banks?
So we consider ourselves still to be in the middle of this thing. I mean, the volatility day to day has dropped a little bit, but it's still moving around quite a bit. What we've done is step up our monitoring of the firms, which we always do in these situations. We've not, though, taken it to the highest level. So the highest level, which we have done in previous scenarios, is daily liquidity reporting from the banks. But we actually, for the reason I gave earlier, don't have a reason to do that yet. But we are watching it very closely, and I think the thing we're watching for next is also what will be the macro impact of all this. So I think the IMF downgraded its forecasts for a number of jurisdictions, including ours, recently. And I think it'll be interesting to see whether our banks in the next period choose to provide more for a different economic environment because they do forward-looking provisions now. So that's where our focus is at the moment.
But do you draw any conclusions about, I mean, the key thing that I seem to recall is what most banks are concerned about is the sort of capital buffer requirements and some of the obligations you sort of put around to banks to essentially insure them against themselves, if you like. Is there any meaningful change you see as likely to be necessary, consequential of what's happened to the US, to the dollar, and to some of the other movements we see in sort of the value of the currencies?
So in this case, we think not. We haven't had major capital movements either on the banking side or the insurance side, by the way, as a result of these movements. For the insurers, that movement in dollars is unusual, but because of their hedging practices, actually was quite beneficial from a liquidity point of view. For me, the bigger point is that when you go into these things, and I'll bring in Mr. Bailey as well, if I might, you want to be sure that the core of your financial system is stable. That becomes a dominating thing, and ours is, and that's a very good thing to have in this situation. But maybe Mr. Bailey was going to add a comment.
David Bailey.
The only thing I was going to add previously was as part of our protocols when we're looking at market events like this, there is a lot of collaboration with overseas authorities as well, given London's role as home to lots of international banks and insurers, and therefore we spent a lot of time talking to other regulators about their experiences, which seem similar.
Yeah. And I think the chair wants to come on to these matters, so I don't want to intrude on her questions. But has there been any reduction in the cooperation that you've seen since the new administration took office?
I was going to say, the supervisory cooperation is always very close and has been for many years with a range of authorities. That has continued.
Has it changed?
I think what I would say is, look, in one respect, it's moved in a positive direction, which is that we've had very good relations with our colleagues in the EU, but I can tell you that one byproduct of these events is that the warmth is increasing quite considerably. So that's actually a good thing. In the US, as David said, we've had very strong cooperation for many years. We're also used to the difference in the US is that the person who does my job is politically aligned, and we've worked with both sides of the aisle very effectively. We know the incoming head of supervision at the Fed, Mickey Bowman, very well. So I'd expect that to continue. But my only caveat would perhaps be that, as we sit here today, none of the three key heads of the agencies in the US have been confirmed. And until they're confirmed and we engage properly, I think the jury's a little bit out.
Yeah, because can I push on that then? Because you've got, as you say, you've worked with people across the aisle in what you might call normal circumstances. But I suppose we're using the phrase Liberation Day now. When that happened, we're seeing a very rapid change in tone across the US administration. Have you scenario planned for more political appointees doing things in the vein of what President Trump is trying to achieve?
So look, we have done work around that. I was actually in the US all of last week for the IMF spring meetings in order to try and get a better feel for what was going on. And in particular, we may come on to this later, but I was a little bit concerned by my own reading of a speech made by their Treasury Secretary, Scott Bessent, on the 9th of April, because of what he said about Basel, which I read as possibly suggesting that the US would not take forward the Basel package. I was very roundly reassured by a very wide range of stakeholders in the US, both public and private, that that's not the right way to read that speech. But we're caught up in that dynamic. We're also doing a little bit of thinking around, back to that Wednesday, if this has created a bit of a dent, I think, in the way that the US is seen both by regulators and investors. And we're asking ourselves the question, what would happen if there was a more fundamental drop in appetite for either dollar-denominated assets or US assets or treasuries or some version of that? It's a difficult question to answer, but it is thinking that we're doing.
So there are risks and opportunities there, of course. I mean, if they drop regulation, I guess there could be an exodus to the US, potentially. But on the other hand, good regulation is quite a good opportunity for businesses to show they're a safe bet. So have you done an analysis of where you think that might fall in different scenarios?
Look, I think you're right to say it's two-sided. So I think in particular one advantage that we have in this situation is that on the one hand, we've been given our new secondary objective on competitiveness and growth. We may come on to that in the session. We're doing a lot on that. That's very clear to steer from Parliament. But it is absolutely clear that safety and soundness and policyholder protection come first. And of course, Mr. Glenn was very involved in that in his previous role. And I think the government and parliament in this country are very clear about the importance of institutions and institutions not being political. I think all of that is an advantage in the current setting.
Okay, that's very helpful. Thank you. Yuan Yang MP.
Mr. Woods, you mentioned just then that your interpretation of the Besant speech was that the US might completely scrap the Basel implementation, and you received advice that wasn't the case. Could you just describe that a bit more, and whether you have more clarity on the US implementation of Basel 3.1?
Yes, I'll give you as much clarity as I can, which is a certain amount. I read the speech as suggesting perhaps a weakening of the appetite because of the way it was framed and the suggestion that Basel might be a kind of pick and mix type of option, which we don't consider it to be. What was explained to me in the US was a number of things. First of all, that it is very clearly the position now of the big US banks that they support Basel implementation. Mm-hmm. They do not support the version of it which was being led by my former colleague in the US, Michael Barr, which would have resulted in a significant increase in capital requirements. They've been strongly opposed to that. But they do support a version of it which is capital neutral. Now, it might seem curious that the position of the banks is relevant, to whether or not they do it in this way, but I think actually that is an important input to the debate in the US. I've also observed that the US in general has been making clear that it wants to remain part of international organisations. So there was a different speech that Mr. Besant gave last week about the position with the IMF and the World Bank, which was very clearly in that vein, and I'm told that that mood sort of pervades other organisations as well, which would include Basel. So I think, and maybe one more point, which is that Mickey Bowman, who says Michael Barr's successor, they're not yet confirmed, has been on the record being clear that she wants to implement Basel. So this has given me more confidence, but I say more confidence. I think we need to wait for a bit longer to see what they say, particularly once the 3 appointees are in place. I think it'll be quite important to see what they say.
And could I just add that I sit on the Basel Committee, and colleagues of mine sit on the insurance equivalent, and the US remain very active in those bodies and have done so over the start of the year. So that points to their ongoing engagement, but as Sam said, we need to wait for the appointees to sort of settle in and get confirmed.
Thank you, that's really interesting. Mr. Woods, if the US tries to implement a capital neutral version of Basel, does that imply that you in the UK would also want to implement a similar regime that's capital neutral?
Maybe I can say a word, and also Ms. Castell has been a lot involved in our debates on Basel, so she may want to add something or not. Our package is already actually capital neutral, so we've designed it. We did not want to use this package to greatly increase the level of capital in the UK banking system, because we think we're at about the right level at the moment, and we can come on to explain why that is later if the committee's interested. What the package does is move capital around within the system so that it's better matched to the risks that we have. That's what it's about for us. So I think if the US comes in with a capital neutral package, that will be fine. It's also, by the way, the case that, most ways, indeed all ways that we measure it, the current US settings are a bit tougher than the UK and EU settings. So I think if they come in neutral, that's just not going to be a problem for us. But maybe I could bring in Ms. Castell as well.
Ms. Castell.
Yes, so thank you. So I agree with Mr. Woods that it is fairly much neutral, but is more risk sensitive, and therefore is beneficial for banks because that gives them a bit better calibration. And the other thing that's important about Basel 3.1 is that it then also enables the capital element for Strong and Simple, which obviously is a benefit to the UK economy in terms of growth.
Thank you. So just to clarify, from your description of capital neutral, that at the aggregate level, there might not be more capital raising, but between firms, some might need to raise and some might need to lower. Is that what you're...
Yes, that's exactly right. So the moving parts within that, you can never land these things, so that no one's capital requirement changes at all, if so there wouldn't be much point in doing it. But at the aggregate level, we've tried to bring it in flat, and that's what we've done. And
what's the view of I don't know if you've already consulted with banks on that proposed implementation, but what's their view on this?
Well, so it was interesting because we in January pushed back our implementation by year to the 1st of January 27, and we did that for one reason and one reason only, which was to allow a little bit more time for some greater clarity to emerge about whether the US is going ahead or not. I think that is in the process of emerging now. The reaction to that from the banks was pretty mixed. Those with substantial trading operations, which are cross-border, welcomed it because they were concerned about the competitive aspect of us going ahead while the US position was unclear and significantly delayed. A lot of our domestic banks were not terribly happy with it because they'd rather just get on with it at this stage. And in particular, Ms. Castell referred to strong and simple. That's our name we use for our simpler regime for little banks. That is sort of backed up in the yard behind Basel 3.1 because Basel 3.1 will form the base layer, pillar one, for that regime. So there's a mixed view. We, frankly, are very keen to get on with it, and I'm optimistic there will be a chance to do that. The European Commission has been consulting on its approach, and there are some ideas there which I think we're looking to. Maybe we can borrow some of those.
How much do you see the risk of the European Commission and European Central Bank being more positive about pushing forward with this while the UK is still waiting for the US to move?
Well, a great advantage we have, and I'll perhaps bring in Mr. Bailey as well, is that we can move much quicker than the EU machine. This is a benefit of Brexit, in fact. At least I consider it to be so. So they have stated that they will come out with their direction amidst the various options that they've been consulting on, either next month or the month after. I think they probably will do that because they've got 1 Jan 26 coming down the track in terms of their implementation of the trading book side of this, which is known as FRTB. I think what we will do is we're engaging with our EU colleagues, we'll watch where they land, and at that point we'll bring something to the committee, to Ms. Castell and colleagues at our end, the Prudential Regulation Committee, to say, okay, this is where the EU's at, this is the best intelligence we have at this point around where the US is getting to, and we recommend this way forward. I don't know if Mr. Bailey wants to add.
So the only bit I'd add, so the EU have already implemented quite a lot of the package, so they did that as of the start of this year, rules around credit and operational risk. So the element outstanding is the trading book rules, and that's what we're having very good dialogue with, and that is the piece, as Mr. Woods has mentioned, that really matters for firms that operate on a cross-border basis. So we're in regular dialogue with them, as we are with the US, and we'll monitor things going forward. But there's good discussions, which I think points to constructive ways forward.
Thank you.
Mr. Glenn.
Can I just ask about sort of reconciling the US approach to the EU's approach and our approach? You mentioned, Mr. Woods, the opportunity that Brexit allows us to move more swiftly. But there are some that would play a narrative to you around competitiveness of the UK banking sector is enhanced by the freedom that you have to move quickly and do things differently. In practice, is that a mistaken narrative in the sense that if we were meaningfully misaligned to either jurisdiction, it would cause other challenges? Can you explain whether that is a fair assessment of the discretion you have or not?
Look, I think there's a lot that we can do, and in particular we can tailor the regulation more to the dynamics of our own market than we were able to do when we were part of the bigger club in the EU. And it would be crazy to have done Brexit and not to do that. So we have been doing that, and that's a clear advantage. But you're right to indicate, if I understand the drift of your point correctly, that there is a kind of flaw in this. FLOOR rather than a mistake in it. There may be other flaws too, but
Prudent by name and nature.
English version.
For the record. That we have to be alive to what's going on in the US and the EU particularly, and we've also considered it very important that we make ourselves compliant with the standard, because we think if we're going to host a big international financial centre, that's an important part of it. So part of David's job, and it's a very difficult one, is to try and balance where are the EU and US and other jurisdictions going, how do we stay compliant, and then how do we also tailor to accommodate kind of local needs. And perhaps the slight frustration of the situation is we got to that position, including having the Chancellor content, which she has to be because only Parliament can switch off the old rules, which will require a recommendation from the Treasury. We'd got to that point, but then the change in the political scene in the US meant we had to hit the pause button. I hope it's just a pause button.
Thank you very much.
Okay, well, we could talk about the US all morning. I'll go over to Rachel Blake, MP.
Thank you, Chair. I'd like to move us on to talking about growth and regulation. And in your Mansion House speech, you talked about the myth of needing a bonfire regulation towards growth. And you concluded that the truth is more balanced, saying that you don't see any compelling evidence for the idea that the big planks of the post-crisis regulations have been fundamentally miscalibrated. So is the government wrong when it writes to regulators asking for changes to the current framework?
Thank you, Ms. Blake. I don't think the government is wrong, but I'll explain to you why. It's that when we look at the really big planks, what are those big planks? Bank capital, bank liquidity, capital and insurance companies, the types of responsibilities we have on CEOs of big firms. I've not seen any convincing evidence that those have been overdone in the post-crisis reforms or what we've done on the insurance side. And that's at its root because we don't see any tension between or trade-off between financial stability and growth. In fact, the opposite is true. There's a very significant trade-off between financial instability and growth, and we can quantify that because we know that the average cost of a financial crisis is 63% of GDP. That's the present value. So we know there's a trade-off in that direction. But if you drop down one level and you say, okay, but in terms of how we pursue that objective and how we hold together the system, are there trade-offs to be made? Well, there are trade-offs to be made. Bank capital is a good example. I could explain that more if you like. But also, 10 or 15 years of very significant regulatory expansion since the financial crisis, which all of us have been involved in and members of this committee too. And also with our exit of the EU, we can look at things again, and there are some things where we can pull back a bit, we can simplify. And I think what Parliament's asked us to do through the secondary objective is that. I read what government is asking us to do as the same, so we don't yet have a kind of problem with that.
Thanks. I would like to come on to some of what's in your letter and what you intend to do, but I just wanted to ask as well and reflect on some of the evidence that Nikhil Rathi has brought around risk of company failure and whether or not the government and consumers are going to have to accept a higher risk of company failure if these regulations, a change in regulations is going to be effective.
So I think that's a wise point for Nikhil to make. I think it manifests a bit differently for the FCA than it does for the PRA. The reason is that we, from the very first day of the PRA's existence, have said we are not a zero failure regulator. And indeed, this is not much discussed, but if you want to bring that to life, under our competition objective, which we've had since very near the beginning of the PRA, we have actually authorised 40 new banks in the UK in the last 12 years or so. We've authorised 80, but 40 of them were genuine de novo UK banks. We've also exited about 20. Now, some of that has been quite spectacular, like Silicon Valley Bank or Credit Suisse. A lot of it has required a huge amount of work by us in difficult circumstances, but been taken care of more quietly. I judge that we've got that appetite, that you have the appetite for that to be going on, and that's all right. So I think we can progress what we're doing under our secondary objective in that same philosophy. I think at the FCA end, it's a little bit sharper that moving some of those dials will actually result in higher failures, perhaps higher costs falling back on the deposit guarantee scheme, or maybe cost to consumers. So that's why I think he's making that point particularly strongly to you.
Okay, and in terms of some of the ideas that we'll come on to, how much growth do you think is available from your proposals in the letters that you've written to government?
Well, I must be honest with you, we have not attempted to quantify the GDP impact of what we're doing, because I think that would tie up an enormous amount of our resource for a very uncertain outcome. I did see that the government took a swing at it in its recent regulatory action plan. I think they went back to a Better Regulation Task Force report from 2005, which looked at some Dutch and American studies in this context. But what we can see is that the steps we're taking are removing some constraints in the system. We could go through some of them individually, if you like.
Okay, I wanted to come on to your proposals around increasing the ability of the insurance sector to invest in the UK economy, and how you see those proposals, the timeline of those proposals, and what you anticipate the outcomes to be.
So, very early days. As we have this meeting, the full regime, and Ms. Castell and I spent a lot of time on this in the Prudential Regulation Committee, only came in 4 months ago. The matching adjustment changes actually came in 6 months before that, so we're about 10 months in. What I can tell you is that during that time, we've had 9 firms go through what we call our application readiness assessment process, which is a new kind of get-ready thing we've got for those investments. Those have gone pretty well. They've been quite quick, 18 days on average each. And we've had 10 firms come to us for new approvals for the matching adjustment, which is a regulatory treatment that's particularly relevant to the area you're asking about. Interestingly, of those 10, only 2 asked to have permissions for the new flexibilities, which are for these highly predictable assets. And the type of assets that they were looking for were still traded assets, things like callable bonds and things of that kind. So for that reason, it's pretty early days still. I think from the committee's point of view, if I might be so bold, the commitment that the industry made, the insurance industry, to make another 100 billion of investment, that's not for us to track. It's not our commitment, but it is a commitment the industry made. Mr. Glynn is very familiar with it from the time. And I think keeping track of where that's getting to would be a good way to kind of keep track of your question.
So just so I've understood, only 2 firms have asked for this variation about predictability.
So far, that's the case, and perhaps I could bring in Mr. Bailey.
As you said, what do you think that means in terms of the changes?
No, I think firms are taking time to adjust to the new regime. That's reasonable. I mean, insurance is a long-term business. I don't think we should expect it to turn on a dime overnight. We are bringing forward something else, which maybe Mr. Bailey is going to touch on, which is our accelerator, which could ease us a bit. And I don't know whether that
was going to come in on. So I was going to say, so it's early days, and obviously the investment opportunities have to be there for the insurers as well. But we're also doing 2 things alongside the reforms that Sam mentioned we'd already implemented. The first is to bring, and we've just put out a consultation on what we're calling our investment accelerator, which will enable insurance firms to put certain assets in their matching adjustment portfolio without our approval for a time-limited period while we go through the approval process. And that's a novel approach which will enable insurers to take advantage of investment opportunities much swifter. And then we're also on the back of discussions with Treasury, in discussions with the National Wealth Fund about how we can facilitate insurers being more active in the investment opportunities that the National Wealth Fund bring to fruition. And we've already seen some announcements that indicate that that is happening. So, for example, Rossi recently announced an investment in social housing refit programme, which has come through discussions with the National Wealth Fund.
Thank you very much. Could I have a bit more time, Chair, to ask about the concierge programme that you're bringing forward, and what is the evidence that you think this is going to really change the dial, and what's the timeline for implementation?
So the evidence really comes from Singapore. So that's where they have one of these services. There are some in other places, but we've looked at that. I've been out there and talked to the team there. And I think there is credible evidence, and I've also heard it directly from firms on the receiving end of that service, so that has helped the competitiveness of that jurisdiction. And I think it's the sort of thing that we should be looking at in this environment, because I don't think that it in any way endangers, if we do it in the right way, our primary objectives, but it can clearly speak to the secondary. So our team, the framework our team has come up with for thinking about how do we affect competitiveness and growth, I find it quite helpful. They basically say we affect it in 3 ways, and it's relevant to your question. One is the allocation of capital in the economy. I don't think concierge does that much of that. 2 is how well UK firms can compete abroad. It's irrelevant to that. The 3rd is how attractive the UK is as a location for foreign firms. This speaks directly to the 3rd. So that idea was very warmly received by the government. We've had intensive discussions with the Office for Investment, with the Treasury, with the FCA, and also actually with the City of London Corporation, because the Lord Mayor's role is quite closely linked to this. And I expect we'll have an announcement in the summer of the opening of that unit. And I should probably wait until that comes, because it'll probably come from the Chancellor when it comes.
Thanks. And in terms of the content of this programme, will rationalising the number of principles which you're considering to have regards, will that is that about really changing the approach, or is it more about your internal workings and internal processes?
So it's probably more the latter, in the sense of it's just a way of making regulation less cumbersome. I may want to bring in Ms. Castell as well on this point, but we look at our have regards. We have depends how you count them. You can get to different numbers, but say roughly 25, and they fall into a competition bucket, a competitiveness and growth bucket, government economic policy, climate, and then regulatory principles. And for the competition and competitiveness and growth bucket, none of those have regards are problematic or odd when you look at them. But the question is, given we now have objectives on both of those, what is it that a have regard might make us do which we wouldn't already do under the objective? Climate is a bit different. I think if Parliament wants us to have regard to climate issues, we do need something in there, but maybe we could be a bit more efficient and constrained in how they're set up. So these will be decisions for government and for you, not for us. But I wonder if Mr. Castell wants to come in as well.
Yeah, I mean, I think by having those have regards more focused in terms of the additional areas, as Mr. Wood said, it's somewhat duplicative to have them both in an objective and in have regards. And I think, therefore, when you've got I think Mr. Bailey had mentioned to me that, you know, sometimes you can actually get the have regards explanations longer than actually the policy that you're trying to consider. So it somewhat just distorts the perspective and perhaps the focus. So I think it would help in that sense.
So you said that none of them are problematic, particularly on competition and growth, and it is about looking how the policy and the have regards align,
yes,
tidying those up.
I think so.
Yes, I mean, each of them individually is perfectly sensible, but it's just when you look at it collectively, it adds an enormous sort of weight to the cumbersomeness of the policy making process, and we think that can be tidied up.
Thank you very much.
Thank you very much, Ms. Blake. Bobby Dean MP.
Thank you. I'm trying to work out just how expansive reforms to financial regulation might be, because I do sense a mismatch between what I'm hearing from you today and what I've seen in your statements in the past and what the government's been saying. So you will know that the Chancellor said in the Mansion House speech that she thinks that the reforms since 2008 crisis have gone too far, and you kind of rejected that regulatory pendulum idea, I think, on the same evening. And also, just listening to you today, it sounds like there is kind of a lower level of reform that could take place, but fundamentally that primary objective stays the same. I mean, do you register that tension? Do you feel under any pressure to go further than you would like to?
So thank you, Mr. Dean. Look, there is clearly a strong pressure from the government, which is entirely in the public domain, for regulators to push hard on what the government is now sometimes referring to quite openly as deregulation. I understand the motivation for that, which is coming from the very sensible desire to have a high rate of growth in the economy, and perhaps some deregulation can play a part in that. Whether or not there's a serious tension on the substance, at the moment I would say no, for the reason that there are plenty of places where I think we can safely pull back a bit. So it's not only simplifying, we are actually pulling back on some things following the big rebuild in the crisis. So one very obvious example to give you, I've been told in this committee before, it's very unpopular, but on the bonus cap. So that was just a mistake. I don't think we should have done that. We've removed it. Another piece, though, is on the deferral of banking bonuses. So we've taken it out to effectively 8 years. We look at it again and we think that's actually more than we need. We've no desire to go back to the 100% cash out at year-end process we had back in 2008, which is, I think, frankly, a crazy way to pay people in banks or senior people in banks. So there are these areas where we're able to sort of pull back in, and I think we can do that safely. There may come a point in the debate, I don't think we're there yet, but I see some of the lobbying in public might lead us there, where there is a more fundamental challenge to things that we think are central pillars of financial stability. But as yet, I've had no request or push from the government to do such things.
Okay. I mean, you've made this clear distinction between the primary objectives and secondary objectives as well. And it feels like that's a gentle pushback on the government, who have been talking a lot about growth, and you're kind of trying to make sure that's firmly relegated to the secondary objective and not the primary. Could you give some examples of things that you'd be prepared not to do, what you would maybe speak up publicly about if you felt you'd come under pressure from the Chancellor to do?
Sure. So just on the objectives, by the way, the way we see our job is you set our remit here in Parliament. You have set us the objectives in that order and with that hierarchy. As an aside, I happen personally to think that the way that's being done is very sensible, but in a way that's kind of irrelevant. You give us our mandate, that's what we do. Then, of course, there's always an interest of government, and we have to accommodate that to the extent we can. There's a formal process for that through the remit letter, but as Mr. Glenn knows well, there's obviously a lot of back and forth between the Treasury and us, and that's normal. I think that's how you should expect the state to function. And at the moment, it's true that there's a very, very strong priority on those growth questions. All of it, though, and the government Chancellor is very clear about this, is that stability. You need stability before you can have reform, before you can have investment. So I think in that sense we're aligned. The sort of things that would cause attention, I think, would be, but to be clear, these have not occurred. But if the government suggested to us that it thought that the level of capitalisation in the banking system was enormously too high and should be greatly reduced, I think you would definitely have an argument about that. We already had a very significant debate with the government actually when Mr. Glenn was in government about an aspect of the Solvency UK regime. We took that pretty far. I remember being asked in this committee whether I was going to resign about it, so I think we took that to the limit. So you will naturally have these things, and I think you'll sometimes, the incentives and objectives of a government and a Treasury will sometimes be different from those of the regulator, and it's natural that you should have some of that tension. I think that's okay.
Mr. Bailey.
I was just going to come in and say that the competitiveness and growth objective that we got in 2023 has led to a very substantial shift in how we do our work at the PRA, and it's become a real focus of the organisation. We spent a lot of time embedding it, getting the expertise, external expertise in to advise, train up staff right across the organisation. We've changed the way that we're presenting decisions to Ms. Castell and the PRC to make sure that considerations around competitiveness and growth are at the forefront, and we've changed our work programme significantly. Some of the changes that we proposed, Ms. Castell mentioned our strong and simple regime for smaller banks, is a fundamental rewriting of the capital regime for smaller institutions, which enable them to compete better. And we've done a number of other things that we can talk about, but it has led to a very significant change within the organisation. I think you can see that in our work.
I'm wondering if Mr. Castell could come in on this, because you've got a very strong background in risk.
I do have a very strong background.
So you're very much, that must be very much in the forefront of your mind. As a member
it is
of the
very
committee.
much. There's been a huge amount of effort, as Mr. Bailey said, in terms of making sure that we are taking the secondary objectives into account. My one comment would be, we obviously need to make sure, talking about pendulums, that we don't go too far and forget our primary objective. So that's kind of the balance that we have at the PRC.
Can you give, I mean, you obviously can't talk about individual firms. Is there any way you can bring that to life so that we can understand how you, particularly as a risk specialist, are making sure that the judgments...
I think at this point, we're probably, I mean, we've obviously been working on it for some time, but there are a number of things which clearly make a lot of sense, such as strong and simple, which, the Basel rules don't apply to domestic banks. So there are things that we can do that clearly are not going to be damaging to the overall economy that aren't a problem. I guess where, in my head, the concerns are is that if we keep pushing and pushing and pushing, so we can do the things that make sense, we can simplify regulations where they've got too complex, we can reduce reporting where it's kind of we're asking for too much data. But if you get beyond that, then and you're still pushing to find things, then as Mr. Wood say, if you're then sort of saying, well, actually it's too much capital, well, where's the evidence for that? So I think at this stage we're okay. But if I thought, I don't know, in a year's time that we're still trying to find additional ways, then that's probably where the concerns would come. Okay. But not yet.
Okay, thank you.
Yeah, just final question really is about the distinction with the FCA, which you commented on a minute ago. Do you think the stuff about choking off investment and the blockers and the deregulatory drive is actually aimed at other regulators then? Do you think the FCA is who they're talking about? Do you think PRA is not really in scope of this massive deregulatory drive because you've kind of got it broadly right?
No, I think we are in scope of this. I think if you look at the statements that our Chancellor and the Prime Minister have made, they're clearly about all regulators, including us. And perhaps the best test of that is that I am one recipient of the letter which was sent to all the regulators. Off the back of that, look, the political language is very strong. It's less strong than the language in the US and stronger than the language in the EU. I think this will often prove to be the case. But look, I understand that there's a difference between politics and regulation, and I also understand that if you have a role as a very senior politician, part of your job is to set a North Star and set clear direction. So I think we understand all of that, but there has been no suggestion to me in anything I've received from any part of government that they want us to take steps which would undermine financial stability. And so that I regard as consistent with what you've instructed us to do. Now, there may come a point, as Ms. Castell was saying, further down the track, particularly if we complete our simplifications, our removal of complexity, our rowing back where we think we can do it without endangering it, maybe there'll come a point when those tensions are stronger, and the history of financial regulation tells you that point will come. And obviously this committee will have an important role in it at that stage.
Okay, thank you.
Yes, I think we certainly will. John Glenn, maybe.
Yes, having had the privilege of office and a lot of interaction with you, Mr. Woods, during that time, it's now interesting to just reflect on the effect of anything that might have happened during that time. I just want to zone in, if I may, on two aspects. One is on the Solvency II reforms, which was an attempt, as you described, to liberate capital, and the insurance industry, not for you to say, as you say, said they would be able to invest another 100 billion. It seems to me that you're indicating that despite those reforms of some years ago and the characterisation of their effect by politicians, you're suggesting that that quantum of additional free money to invest has not found its place in those investment decisions. Is that correct?
I think what I'm saying, Mr. Glenn, is it's early days, and some very bold and very clear commitments were made by the sector, which were welcomed by the government, and which I judged to be the driving force behind the government's position, or at least a very important part of the position. You can tell me. I don't think you'd expect to see that happen overnight, and indeed, I think that the industry put a time frame on that of 10 years, as I recall. So I don't have reasons on what we've seen so far to worry that will not be the case, but I do think the jury's still out. Okay.
And can I ask you about what do you think about parliamentary sort of endorsement or support for the your execution of the secondary objectives? The purpose of doing so is to have growth and competitiveness and in focus was clear, and this government, as we've discussed, and as Mr. Dean has gone through what tried to say what that means. I was always struck there was a big gap between the technical nature of a lot of your carefully calibrated interventions on capital requirements, etc., and the rhetoric of politicians seeking to sort of drive forward an agenda for the economy. How do you think that process of mutual understanding could be enhanced?
Well, that is a very difficult question to answer. I suppose it's part of the job of people like me and Ms. Castell and Mr. Bailey to bridge that gap as best we can and to translate the imperative we've been given by you in Parliament, and to the extent we can accommodate it also from government, into actual actions that we can take. And it's true that when you get to the actual actions, sometimes they seem modest compared to the language. But I think that's probably likely always to be the case. In our world, though, and looked at through our eyes, these are big things that we're doing. A couple of good examples, I think, from the Solvency II area, which you may recall, is we've actually cut insurance reporting on the number of templates insurers have to give us by a third. That's a big cut. We've cut the number of tests that we do for internal models by more than half. Now, we think we can do those things without increasing risk to policyholders because we think they were overly burdensome. But I can see if you sort of put things like that next to the grand ambition, there's a bit of a gap, but perhaps it'll always be that way.
And finally, on Strong and Simple, the regime you put in place for the smaller banks, and I remember a consortium of them coming to lobby me on this. When you step back,
say when
I was the minister, sorry, long time ago. But one of the sort of questions that I want to sort of try and get to is when you cite that, quite rightly, you have a new banks unit, you have new banks being set up, but we still see in the UK a very small number of banks having a massive share of banking, domestic banking, and a long tail that fit within your Strong and Simple regime, which hopefully will come to fulfilment after the Basel implementation. What more can be done to encourage more meaningful competition, such that, is it about sort of reticence of consumers entirely, or is there more that can be done? Because it does feel like what we've done is enabled several to start up, but not to really compete with the big banks.
Look, I think there's a lot of truth in what you say. Mr. Bailey may want to come in as well, but we see our job as sort of setting tram lines, within which the market can operate because they contain the public interest. And we don't see ourselves as a kind of central planner, if you like, for the banking system. They fight it out amongst themselves. Some succeed and some don't. I thought the most interesting piece that was done this actually, and it was only quite loosely alluded to in a recent FT piece on this question, but I actually think it's very important, is that competition has been operating not only through the market share channel, but also through the product channel. So crudely, the assessment, and the FCA I think would agree with this as a very crude summary, that if you bank with a high street bank, the quality of the app that you have may be better than it would have been without the arrival of the digital banks and all their whizzy apps. And I think that has actually been quite an important part of the market, and it's that dynamism and innovation that comes with it.
But isn't what you, excuse me for interjecting, but isn't it what usually happens is they buy out a little startup with a new functionality and then apply it into their app. And so essentially, they take out the maturing of an alternative platform or entity.
Well, there's a bit of that, but there are also some, apparently very successful, very highly valued startup UK banks who don't seem to have any interest in being taken over in that way. So I regard that as quite lively. But check if Mr. Bailey wants to add at all.
The point I was going to add, when we talk to the smaller banks and we listen to what they want, and they want stability in the regulatory requirements, certainty over what they will be, and then the opportunity to use that to plan ahead. And that's exactly what we're doing with things like the strong and simple regime, in giving them simpler requirements. That's taking out substantial cost for those firms. When we announced the capital changes last year, about 200 million of cost extracted for those small firms, which is a very significant number for them. And the requirements will be more stable over time. We've deliberately designed them so that they can plan ahead and use their capital more effectively than they're able to now. And all of that will help, and then we'll keep talking to them as firms grow, and we have regular dialogue with, for example, the challenger banks, the sort of mid-tiers that have grown out of the smaller banks, around how we can remove further barriers through, for example, reporting.
So when we have the banks in front of us in the near future, which we may, what do you think they're going to be entirely content with what you've done for them through Strong and Simple and through the Prudential rate regulation?
So I think they will recognise that we're taking meaningful steps. Of course, they will want us to go further in a wide range of areas, but that's this kind of sensible debate that we are used to having with industry. What I would say is, in a number of areas where we've been given compelling evidence, we have changed our approach. For example, in Basel III, we made some really important changes after consultation in areas like support for SME and infrastructure lending or trade finance, and we listened to what industry told us, looked at the evidence they gave, and made changes that catered for that.
The thing that most worked up about this, as you know, is the MREL threshold.
Yeah.
And this is a threshold for when banks have to issue an extra layer of loss-absorbing debt to help protect the taxpayer and depositors. We are looking at recalibrating that threshold for the passage of time. And we've had some suggestions from the industry about different ways to do that. So that's something we're looking at closely. That's, of course, a Bank of England thing rather than a PRA thing.
Thank you for both your answers.
Yuan Yang MP.
Mr. Bailey, I was struck by what you said just then on small banks wanting that clarity and certainty of what the future regulatory framework would look like. And I suppose in the Treasury, in the Treasury's conversations with you about, and with the PRA, by you I mean the PRA, about the growth and competitiveness objectives, I wonder if you feel that there may be some trade-off between introduced by changing the overall priorities within the PRA and other regulators, that therefore then introduces some uncertainty about the regulatory regime for those banks that, as you say, are now trying to create that stability. And that seems to be the case certainly in terms of the postponement of Basel 3.1, but I was wondering if you take that as a broader consideration.
It's a good question, and look, change will always introduce some uncertainty. Necessarily as we go through our formal policy process, because we put forward some proposals, have a sensible discussion with industry about them, and calibrate our final proposals accordingly. But for the smaller banks, we see the strong and simple regime as the way forward. We want to implement that as soon as possible, and we'll do that as soon as we can implement the Basel package. But what we have done is we've accelerated some of the changes in advance. So, for example, the changes to liquidity requirements and disclosure requirements, which are very meaningful for the smaller firms, are already in effect. And we estimate around 80 firms have the potential to sign up for those reforms. Over 50 have already done so without having clarity over the final capital package. So I think we'll have a very significant proportion taking advantage, and I think that shows that they're successful, and we'll give clarity on the final requirements as soon as we can, and get them in as soon as we can after the Basel package.
Thank you. Do you see that there is a potential trade-off between the growth and competitiveness, between moving to more growth and competitiveness objectives and the stability of regulation for firms, and is that a trade-off that the Treasury consider as well in their conversations with you?
As Mr. Woods has already said, so we think there is there's no trade-off between financial stability and growth. You need that stable environment from which to grow over the medium to to long term. And what we're seeking to do is make sure that we can deliver efficiency and proportionality in our regulation in a way that maintains that maintains an appropriate level of resilience. And that's exactly why it's called Strong and Simple. We're simplifying significantly whilst making sure that the regime delivers meaningful resilience.
If I could add just briefly that, I think you're getting at a very important point, Ms. Young, which is actually stability in our regulation is one of the things that the industry wants most. Frankly, I think that's pretty reasonable after 10 or 15 years of massive change. We can't keep on changing at the same pace we wouldn't want to. And there is a bit of a tension. I think, again, it's a bit sharper on the FCA side, but some of the things that we want to do to change do require a bit of effort from industry. So those reporting changes on the insurance side I was talking to Mr. Glenn about, there was a cost to make the change. We had a range of how much that was, about £130 million for the industry. But then you get a £60 million a year benefit. So that's a reasonably good payback. But we have those sorts of tensions that we're trying to manage.
Yeah, thank you.
Thank you very much. Lola McAvoy, MP.
Thank you, Chair. Moving on to AI, and we know that the government are pushing forward with the AI growth zones, and the committee's heard, and I'm sure everyone in the room is aware, that AI has the great potential to tackle the productivity problems that we've got in the UK. Mr. Woods, what's your assessment of the impact of the increased adoption of AI, particularly generative AI, in the financial sector on your regulatory responsibilities?
So thanks, Ms. McAvoy. In a word or two words, it's pretty substantial. So we know that 3/4 of firms are now using AI actively. Within that, 41% are using it to drive efficiencies within their business, which is the sort of thing I think you were touching on. We're obviously doing that ourselves as well. You're probably doing it here in Parliament. About a third are using it for fraud and a third for cyber defence. Now, those sorts of uses, I think we want firms to be doing that in general. We would generally tend to think that those were kind of pro-safety and soundness, and indeed, if they weren't doing any of that, we perhaps would be a bit concerned. The area which is a bit more exploratory at this stage are things closer to the heart of what we do. So for credit assessment, 16% of firms are already using AI in some way in their credit assessment, but another 19% tell us that they will do so within the next 3 years. If you go to algo trading, 11% already doing it, 9% more say they'll do it. And then capital management, which is right at the heart of what we do, actually there it's only 4%, but another 10% they say they'll do it. So all of that is growing. We know from previous surveys that those leading numbers are quite a good indication of what will happen. And I think we need to be very close to what happens there. It will probably be our approach that for important decisions, we expect in the end there to be a human involved. And crucially, under the senior managers regime, we will hold people account for the machines that they're in charge of.
Excellent, that's reassuring. So to all of you individually on the panel, where would you place yourself in your opinion, both your professional and personal opinion, on the scale of extreme sceptic to zealous advocates for the impact of generative AI on financial stability?
Okay, well, I'll go first. Can I be at both ends? I mean, I think from as the chair alluded to, I do have a risk background, and that is where I come from. And for me, clearly there is huge potential from AI in terms of both for firms and protecting themselves, but also improving processes, doing things faster, doing things differently. But there is that risk that AI can start potentially, the worst, taking over and even kind of stopping humans intervening if it gets too far. So for me, it's also a good thing because it gets firms to focus on data, which I think a lot of firms historically have not focused enough on having high quality data, and that really matters for effective use of AI. But we still, there are still hallucinations. You can have these catastrophic memory failures. And what I really worry about is, we've had some conversations, I think it was actually joint with the FPC, talking about some firms talking to us. Big firms have strong guardrails. They can think carefully about how they're going to manage the AI issues, what governance they put around it. I worry that the pressure is so much on firms to use AI. How can they do things quicker, better, faster? That making sure that you have the right human oversight, I really do worry quite. You look at some of the model, looking at how firms use models, just credit risk models, which are not as far as going into the AI, generative AI space, you still have senior management in places where they don't necessarily fully understand the models. We know that. There I mentioned the Horizon system, right? That's another one which is not an AI model, and yet people couldn't test it, challenge it. So for me, I guess if you were going to put me somewhere on that, I see huge opportunities, but I am very nervous that the pressure will mean that we go too fast.
Thank you.
I think it's well put by Ms. Castell. Of course, catastrophic memory failure can affect us humans as well. Hopefully not in front of this committee. But if 1 is the skeptic and 10 is the zealot, in terms of how big a deal this is going to be, I think I'm probably at a 6 or a 7. I think this is really pretty material. That brings risks and opportunities with it. I mean, I don't think it is fair to think of this, at least I don't, as a kind of akin to the arrival of the internet, but I think it is something really pretty significant. We can see that in our own work. So I do think it's something we're going to have to be very, very much across in coming years.
And I'm actually very optimistic about the opportunities. What I think is really important, though, is that we have an ongoing dialogue with industry to understand how AI is being leveraged so we can help manage the risks. And we have that. We've had a couple of years ago, we had a public-private forum to discuss AI with industry. We're just launching a consortium with industry to discuss exactly what the opportunities look like and how we can manage the risks associated with it. So I think it needs a really detailed and ongoing dialogue with industry and a range of third-party providers to make sure we understand the risks and can therefore make sure they're managed and firms are managing them accordingly.
And just on that point specifically, do you think in your organisation, have you got the skills internally to understand, we talked about the skill gap and how few people actually understand the engineering of it. Do you think you've got the skills? Do you need any more skills? Are you hiring people with these expertise?
So we always need to evolve our skills as our skill sets as the risk landscape changes. This is an area where, again, we need to. I think I'd always say at the moment we need more resource with expertise in this space, but we are building that, and that's where the dialogue with industry comes in place. And obviously, when we put in place rules in any particular area, then there's a strong appetite for industry to come and grab our staff and take them across to firms to advise on how to meet our regulations. So we need to keep working on that, but I'm confident we've got the right channels to build that expertise.
Great, thank you. And then,
can I just ask about the pool of people to fish from with AI skills? I mean, is there an issue there? Because although it's not directly your remit, you are a big player and will have concerns if this doesn't work.
We have still found that we can attract the right sort of talent. I'll tell you how we're doing it, though. It's actually the most sort of AI-aware and enabled talent that we have is talent we are recruiting to work on our own digital processes. We get quite a lot in that way. It is typically younger staff. We actually have, though, recently recruited a new head of division for us up in Leeds, and we're planning to build up our presence in Leeds in this area where we know there's a lot of talent there. So we think that's quite a good way for us to go after it. It's tough, as David says, but we do find that at the moment, at least for the moment, we feel that
Are you having to pay them more?
We've been able to do it within our pay scales, actually. That's always a tension for us, but people do join us also for other reasons in terms of the mission and the brand of the bank and things of that kind.
Thank you. Just moving on a little bit to go probe into some of the concerns that I think are out publicly. There's been reporting that AI algorithms based on trends in social media networks can amplify false messages and misleading information. How concerned are you about that influence seeping into trading decisions and your role to regulate?
Well, maybe I say a word, and Ms. Castell may want to come in too. I think a lot of that is already with us through social media, not through AI. So I have personally had the experience of an entirely false social media run on a UK bank, which we had to intervene in at high speed to stop it by making it clear that the rumour was just untrue. That is a relatively new phenomenon. If you look at the speed of bank runs that we had, in the 2023 turmoil, particularly Silicon Valley and other banks in the US, those are stunningly fast, driven, I think, by social media, not by AI. Now, AI could be a further exacerbator in that respect. And certainly in traded markets, we do have a worry that the herding that we already have in markets could potentially be exacerbated by the latest forms of AI. But some forms of AI have been used in algo trading for quite some time. So I think it's probably more potential accentuation Our colleague on the FPC, John Hall, gave a very good speech about all this, which I think is a pretty good.
My colleague Bobby Dean's going to come on to that, yeah.
Oh, right, okay. But I don't know whether Ms. Castell wants to.
No, I think clearly it has the potential to, as that speech talked about, potentially cause aggravation. I think where probably I would get concerned is, if that starts, the market the banks, for example, have a lot of exposure to non-bank financial institutions, and any sort of disruption in that market is already strained, obviously, in the current volatility. So, banks are financing private equity in different ways these days, and there's a lot of exposure there. So if you get some kind of severe shock, that would be the area where whether that would have an impact back onto the firms that we regulate.
Just two more questions on that point. So can you tell us a little bit more about this run on and the social media impact on this run on the bank and what happened?
Yes, what happened was, this was actually back, I think it was 2019, and actually what happened was that a false rumour about the resilience of that institution was spread. It was actually, this is how old school it was spread on Facebook. And we got a window into that, actually, in the very first instance, because one of our staff members was a member of the relevant group on Facebook, so saw it quickly, so we could get onto it very quickly and deal with that. But we did have queues in that bank with people looking to withdraw assets from it. So I think that's just the world that we're living in. Part of the answer to that is to try and make sure that our liquidity regulation takes account of those things. But also there is a role for the central bank as a lender of last resort. So if you have a catastrophic run, you'll never have enough liquidity to meet that, because the point of banking is partly to lend it out on the other side, or for most banks anyway. So that's how I'd characterise that one. But I think the events of 23 also showed that.
So there's a body of work going on at the moment that I'm quite interested in around the marketing and identification of bot accounts on social media. And Yuval Harari has come up and spoken about this and said that basically you should brand bots early now and take action to do that, so that where there are fake accounts that are driving things for ulterior motives, that can obviously be identified by an average human user. How closely are you working with Ofcom as the regulator implementing the Online Safety Act to make sure that your responsibilities align and are supported through their work?
Mr. Woods.
Well, that's a very interesting point, and I should look at that work by Harari. We are engaged with Ofcom a bit, but not in detail on that point. Maybe makes you think that we should be. What we are working on is on the implementation of the critical third-party regime, which you've mandated us to bring forward. I think that is relevant in this space, and that one of the things we worry about is a kind of particularly strong dependency on a few suppliers, and I think that regime may help us in this space. But I think probably we should check in with Ofcom, and as David told us, we've done more. We should probably take that away.
Thank you.
Thank you very much. Bobby Dean.
Thank you. You mentioned how obviously some AI systems have been around in the sector for some time, so I'm interested in kind of how new or how well equipped you feel that you are to deal with this sort of new interest in AI. I saw in the bank's survey that firms were saying that the key risks are third-party dependencies, model complexity, and embedded or hidden models. And I just thought to myself, I wonder how much of that is actually new. You probably have experience of dealing with those risks already. Do you feel well equipped to deal with these risks, or do you think you need further regulatory powers to deal with it?
So, for the moment and today, our approach has been tech agnostic. So we said we think we can create regulations to deliver our objectives without specifying particular technologies. So in this space, the most relevant things are our model risk management guidelines, the work we have around operational resilience, and what we do around data. We are debating internally, actually, at this moment, and we haven't come to a settled view on it yet, whether that still continues to hold for this particular technological development, or whether it may become necessary to supplement a bit in part. We say, well, here's the general model risk management approach. By the way, if you are using a foundation model to do something in this space, you may need also to be aware of X. We're asking ourselves that question, but it's not obvious to me that the answer to that question will be yes. In terms of sort of resource and capability, it always makes me uneasy answering this sort of question, because I feel we're on top of it for the moment, but it is a very fast evolving field, and it is always, of course, possible that we have missed something or are behind the eight ball on something important. I can't see that at the moment, but that's something I think we need to keep asking ourselves.
Okay, thank you. And just focusing on third-party dependencies in particular, I'm sure again it already exists in the sector where people are particularly reliant on a piece of software or hardware and so on. But it's kind of well documented that there's a handful of large tech companies dominating this at the moment. Some from countries that we would regard as allies, some that are not. Some that are becoming unreliable allies, you might say. Do you worry about that, about the amount of exposure to these technologies being concentrated in such few hands?
Look, we do worry about that, and I'll bring in Mr. Bailey as well. It was really for that reason that we were quite keen to bring in this critical third-party regime. One example of what you're describing, which is a non-AI example, is the cloud. So there are some very clear leaders in that field. Many of them based in other jurisdictions. Having said that, our typical approach has been to be quite open to cross-border business in various shapes, either on the back end, which we're talking about now, or on the front end in terms of firms' exposures through the financial centre. So we're trying to stick to that while having sensible sight and line into those dependencies. But maybe I can bring in Mr. Bailey.
Thank you. Yes, just to build on that. So we do place obligations on firms, the banks and insurers we regulate, to manage their third-party relationships carefully, as well as bringing forward the critical third-party regime. It's really important for us that banks and insurers are doing what they can to understand, assess and manage the risks. And in many cases, actually using third parties can make them more resilient. So cloud is a really good example where a number of firms have replaced have moved services onto the cloud, which were otherwise dependent on legacy systems, which were quite frankly creaking. And therefore there are real resiliency benefits. We just need to understand the risks and manage them, make sure firms are managing them, and then where you've got systemic nodes of importance within the system, like critical third parties, we have the ability to step in ourselves.
And I guess in other sectors at the moment, given the sort of volatility in global relations and the kind of effective oligopoly you've got in some of these sectors, people are saying it's a matter of economic security. We need to develop our own industries, we need to develop our own products. Do you think that should be a concern for Britain's financial sector too, given how vital the financial sector is to Britain's economy? Does Britain need to start thinking about developing its own competitors?
Well, I think, look, it's an example of the thing we're seeing more widely, which is the world has become massively more connected, massively more electronified, and massively more digital in terms of how we use all these things. And that does mean that events can spread and propagate much more rapidly through our system and with much bigger effects than used to be the case. And I mean, the power outages we've seen in Spain and Portugal, I'm sure that would always be a big deal, but there's the increasing impact that if telecoms go down, a whole bunch of stuff that people are relying on doesn't work properly anymore. Whether the right response to that is for people to develop their own solutions to all these things and insure them, if you like, I think that's really a question for governments. I don't think we would start from that perspective at all. We have, as I say, historically been very open. I think there are benefits to us of being open. But you need to be intelligently and responsibly open. And so that's what we try to do, both on the operational side, which we're on here, and on the financial side, which we have a lot of too.
Okay,
Thank you very much, Mr. Dean. Rachel Blake, MP.
Thank you, Chair. In 2019, you gave some fascinating evidence about credit unions and their sustainability, and I wanted to ask what you think is happening to the credit union market at the moment, because the average of failures is going down. That could either suggest that they're becoming more resilient, or perhaps what I think, which is we've got a survival of the fittest situation going on, and larger ones just have just about been able to cope. I'd be interested in your theory about this.
Well, I think you're absolutely right. I subscribe to your second theory, not the first one. And I remember that discussion back in 2019. I think it was mainly with Mr. Streeting, who's obviously gone on to other things. For me, the pattern in this area has been the same actually since I started this job in 2016, and it's the one that you described. So when I started this job, there were 496 credit unions. Today there are 358. But at the same time, the value of assets in the sector has been going up. So since that discussion, since 2020, it's actually gone up from 3.8 billion to 4.6 billion. So you are seeing a consolidation. We do regard that as a natural phenomenon because of some of the fixed costs that there are involved in operating even these very small operations. The only caveat I would make is that being big is definitely not a guarantee that you will survive. So we had, I wrote to the chair in her constituency role on the 22nd of January about the closure of the London Community Credit Union. That was a large union, 22,000 members, 16 million. We had Dial-A-Cab quite recently as well. But it is the case that we're seeing that consolidation, and broadly that seems like a good thing to occur.
Thanks.
Mr. Bailey.
Could I just add one thing, which is, and I used to run the area of the bank that supervised the UK banks, including the credit unions. We do recognise that they provide a really important service within the UK, often servicing communities and sectors that otherwise can't access finance in the same way as others might. And therefore, we do apply very specialist supervision, deliberately targeted, and rules to the credit union sector to support them.
Thank you. Can I just declare an interest as both a member of that recently failed one, and so are some other family members. And what is your understanding of the impact of simplified capital requirements that they've developed since 2019? Do they have a part to play?
So look, I think they've been helpful. So what we did was we removed a whole bunch of tricky little thresholds which credit unions had to keep an eye on, and just simplified it to be total assets. So as you go up, your capital requirement gets higher. And we also moved it for credit unions above 10 million to more of an income tax type approach, because there was a cliff edge where you'd get to a certain size and suddenly you got a bigger capital requirement on your whole asset base, and I think that was off-putting. So I think that has enabled those larger credit unions to grow with more confidence. If I look at the capital levels in the sector, they've kind of been flattish throughout, which I think was our intention, so I don't think those have gone up or down. But as I say, big credit unions can have problems as well as small ones, but we are seeing that consolidation, and it may be that our regime is playing I hope a sort of helpful supporting role in that.
Thank you. And given what you've said about what it will take for credit unions to survive and their capital requirements, what do you see in terms of the current market and environment for them to still be an available product or type of firm for consumers to go to?
Well, look, I see the sector continuing to grow in absolute size while consolidating. That suggests to me that there's a good future for the sector. We've committed to go back to the government with a report on mutuals by the end of the year, and credit unions is a very important part of that. There's an issue around something called credit union service organisations, which are where credit unions typically get together to try and share a service of some kind. At the moment, it's not entirely clear in our rules whether that's allowed or not. We are going to consult shortly to make it clear that that is allowed. But also we need to be careful around those arrangements, because sometimes they can leave a big hole in the balance sheet of credit union if the service provider has a problem. So I think that's the way that I would see it. I don't know if either of my colleagues want to add to that at all.
No, I think that's certainly something, I think, in places like Germany, where the credit unions often have service providers as a way of sharing the costs out to help the credit unions. I think that can be a challenge otherwise as they get bigger.
Thank you very much.
Thank you very much. And one of the things that's being discussed, of course, in government at the moment, we had the Minister in front of us last week, is the ISA regime, and whether there's going to be a lot of swirling speculation whether the cash ISA limit will be dropped down from the current 20,000 in order, I think ministers have said, in order to encourage people to put money into stocks and shares ISAs instead. But the building society sector, of course, has come back and said, hang on, we need this capital to lend for mortgages. Are you watching this? Have you got any opinions on that debate?
Yes, we have been engaged in that debate. It's obviously for government to lead. Our job is to advise on any safety and soundness aspect. The advice we've given is that very sudden and very big changes could cause an issue, particularly at the time that we're withdrawing a certain form of funding called TFSME from the market. But that more gradual changes we don't think should be constrained by safety and soundness considerations. Now, one can then argue, are they a good thing to do or not? But in terms of that angle, that's the view.
So slow and steady is your...
I think if there were to be changes, it would make sense to do them on a sort of forward-looking basis. The other point that the building societies make, and I think it's a fair one, it goes back to Mr. Glenn's joke about free money before, is that money is doing stuff in one place, and it's about moving it to another, and what's the effect of that, and sometimes that gets lost.
Yes, well, I think that's very helpful clarity. Thank you very much for that. But can I thank you all very much indeed for coming? It's been a very interesting discussion, and obviously in summary, we've discussed the work that the PRA had to do, stepping up to monitor firms after Liberation Day, but that you are reassured at the moment there's not been a dramatic impact on the system, and you didn't see that sudden shift in consumer behaviour that you would have been worried about if it had happened. But you are watching very closely for the appointment appointment of the new heads of the relevant bodies in the United States, and that could be significant. So that's obviously something for us all to keep an eye on. And you're very clear, I think, that there's no tension between regulation and secondary growth objective at this stage, but I think Ms Castell laid out the warning markers there about what we might need to keep an eye on as a committee. And of course we discussed the emerging growth opportunities of firms employing AI technologies and the challenges around that. There is risk, but it can be managed. That was quite interesting, something I think that we across the committee corridor in Parliament are keen to keep an eye on. A lot of opportunities, but risks, as Ms Castell also highlighted. But can I thank you very much indeed. That's Sam Woods, who's the Deputy Governor for Prudential Regulation at the Bank of England and Chief Executive of the Prudential Regulation Authority, Tanya Castell, who's an external member of the Prudential Regulation Committee, and David Bailey, Executive Director of the Prudential Policy at the bank. The transcript of this session will be available on the website uncorrected in the next couple of days. Thank you very much indeed. Order.